3, 2, 1.
Hello, Warriors. Today I'm with my trading warrior brother, Henrik Zeberg. Henrik and I have been talking for a long time, many years, right, Henrik?
Oh yeah, it's been quite a while now. So I don't know, 6 or 7 years time. The first time we talked, I think. So a long time.
Okay. Yeah, I think maybe even all the way back to when I was on FX Street. I'm not sure, but Henrik is a great macro guy and at times controversial, which is something we have in common.
Yeah.
I'm not just controversial based upon my market calls, but that's part of it. But something we haven't covered for a long time, Henrik, and I bet your followers probably don't know and your subscribers don't know. But let's get in a time machine for a few minutes before we get to the markets and tell everyone what you were doing before you got involved in the financial business, the market analysis business, and if you had any influences that helped you along the way. Tell us a little bit about the genesis of your career here.
Sure. So, by background, I got a master's degree in economics from the University of Copenhagen. Working as a consultant for many years, also within digital transformation, but markets really have that's my passion. 2008, I was uncomfortably long in properties, investments within properties, and of course that was something that did not go down well, and I kind of maybe learned something there. I learned a lot actually, and the thing was that I started asking myself, was it really that went wrong? Because everybody was so certain that this is going to go well, and that put me on the track in 2008, where I started to really do my own analysis in a much deeper extent than I've done before, and started building the model that I'm now using, which is based on Elliott Wave, which is really on people's behaviors, on psychology of the market. Yes. and then do it multi-market across asset groups, so which gives you a good leverage and a good understanding that it's not just about the US markets, it's about what happens in various markets, and it's also what happens in various assets. So this has been good, and over the years, of course, things have been developing, and I'll say that there have been mistakes over the years, but there's also been some things that have been been improving my model, I would say. So this is it, and but now we're here, and there are some very clear signals in the market, right?
All right. So was Prechter's book a big influence on you when you first started using Elliott, or did you have any other? Yeah, well, it was Prechter's book on Elliott.
It was not there when I started, actually. I started actually with there was a small Danish company, and a market company, analysis company called Demetra that I started out with, and they do some really good analysis, and they use some of it, and then I just got an interest in that, and then Prechter's book obviously, but also other documents, and it's not just about it is about utilizing it's an art, I would say, and the more you get into it, can you be used on very short time frames is where I see most people make the most mistakes, but in the longer time frame, it's really strong.
Interesting.
But you gotta. And
you still have alternate counts, no matter the TF, right?
Yeah, but you would say that if you do it on a multi-market and multi-asset and perspective, then you would either enforce your or strengthen your model and your thesis if you can see that what happens in Dixie also can kind of mirrors in gold and in Bitcoins, and what else do you have?
Yeah, do you believe that, Henrik, that if you can get the dollar right, you could get everything right?
I believe that the dollar is it's pivotal into many things. Yes, I do. And that's also what centers around my analysis is absolutely the dollar as well. Yes.
Okay. So your contrarian stance now, before we have this economic winter that I've talked to you about on several occasions, is that there's going to be this window of time where the market is going to perform quite dramatically to the upside. And that new all-time highs are something that you're looking for, and the melt-up scenario is your primary count for what's happening to stocks. Yesterday looked like it did some short-term damage. I'm sure it doesn't change your long-term view, does it?
No, absolutely not. And actually, I was expecting to see some more downside this week, and I also have a forecast just on a weekly basis, and it showed that we should have some more weakness into this week, and we reached a certain levels. I had around 4,070 on the S&P, which was actually kind of the area that it touched.
It's a very important support level. Yeah. Let me ask you this. As a trader, there's only one thing we could control, and that's not in our narrative. It's the main question is anytime we have a narrative, where are we wrong? Are there any levels that would convince you this melt up is not going to come and that we're headed for one more flush before we get a melt up? Is it possible, Henrik, for us to clean out the October lows first and then have a blow off market to the upside? Is there any count you could come up with that would?
No, I can't come up with it. If I'll be proven horribly wrong, if that happens, I will say that outright, and I'll not be quiet about that on Twitter. I will say that I'm horribly wrong. Horribly wrong. I meant that.
Okay.
If that happens, then it's that would negate, of course, anything that I've said, and there's no doubt about that.
Okay. Any levels above that would give you an early warning, 3,800 or anything like that?
I mean, I very rarely look at just levels, and what I look at is, as I said, you look to the European market, for instance, and you look at the UK has made new highs already, all-time.
Great point.
Highs.
Yeah.
Why would you want to see all-time highs in the UK if the S&P made its high in January last year, and DAX is just close to making highs, also new all-time highs? Why would you see the DAX make a new all-time high in April of 23 if the S&P made its high in January of 22 and NASDAQ in November of 21? So it doesn't add up. It really does not just add up.
So you're saying that, and there are a lot of people that are saying, even for the melt up here, Henrik, that there are better opportunities being in overseas markets because of the dollar. I mean, like you said, they're outperforming the U.S., that there are other markets that might do better than the U.S. on a bull move in the U.S. Do you agree with that?
They may have been here for the short time frame where they have been overperforming, but I think we're going to see a catch up like nothing we have seen for a long time here with the S&P and NASDAQ. And NASDAQ has actually started to move, and saw the Dow was actually one of the first moving. It's really just about the S&P now to get its act together and then start moving up as well. So I'm not too worried about this. And you can see Bitcoin, you see crypto starting to put in bottoms, which is really a liquidity gauge. And all this is happening, and more. You also see some of I got a lot of indicators that I look to, and there's, in my mind, very little doubt that we're going to see something now. Now we also saw durable goods coming out today, stronger than anybody expects. We've seen some bounces in was it last week? It was the manufacturing New York manufacturing index as well. We also saw a bounce there. So I think people are just too early. I mean, the thing is, yes, a recession is coming, and that's actually what I have here. We have the spread here, right? The 10-year minus the 2-year, and what we see simply is that if you look at this, every time we have a negative, we have an inversion here and here and here and here. So we get a recession, but it takes time. So from the bottom of that, we actually have 1 month, 1 year and 3 months here. Here's 1 year and 2 months, and 1 year and 1 month. And then here, we just bottom down here. And if we just add on, say, okay, it'll last around a year. Why should it be immediate? I mean,
where will we be in a year? Is it a year from, it looks like it was a month or two ago. So what are you talking about? A recession mid-year 2024?
No. I think the recession sets in. I think we are pretty much on the same kind of route that we saw in 2007. So that path is that we saw the inversion in 2006, and then we got into 2007, and the recession set in 2007, December of 2007.
Okay.
And I think, but when we get to December of 2007, I would be, very cautious. That's why I'm looking also for a top in the stock market around the same time, which was in October of 2007. So yeah, and that's not just because of this, timeline there, but that's what I'm looking for.
Okay, so this melt up could complete in a year from where we are now, is it?
But that's really the thing. I mean, it's going to go much faster than that. I think we're going to see that. So we got time before the recession set in. When the recession sets in, it's game over, no doubt about it. I mean, that's when we're going to go down. We're going to go down in a really, really bad way, and much, much worse than what we saw during the financial crisis. So this is going to be a bigger bust than what we saw there. I'm quite, and what I base that on, I mean, I base it a lot on Elliott waves and structures. And if I just look here at the emerging markets here, if I can get it loaded here. So and I can take this away, hang on, if I move this away somewhere, there we go. So what I see here in emerging market, which is really important for the world economy, is that we had a decline here during the financial crash, and then we had the financial crisis, and then we have had what has been this sideways kind of thing, but develops into this what I think is a B wave, a larger B wave here. So this is A, this is B, and then C is going to come. And as you said, the dollar is very important, and I think we're going to see a drop in the dollar. I mean, again here
91 to 93. Okay.
Yeah, caution caution on because I think we may see a bounce first up to around 107, maybe 105, 107. But from that on, then I think we're going down to 91, 93. And that will create the blow off. I agree. That's what we could create, the blow off top here, right?
Okay. And so it's all about, again, we come back to the dollar. When the dollar's bad, buy the world. Exactly. I wanted to ask you, a lot of people are talking about the Dow gold ratio of how that's beginning to turn. Does that have any meaning to you?
I haven't watched that for a long time.
Huh?
I haven't watched that for a long time, honestly. I haven't.
Okay. All right.
So, but my thesis on gold is still that we haven't passed that 20. I don't remember how high it went in August.
2100.
2100. We haven't passed that yet, and I don't think we will before we see this kind of move also over here. Because again, in the emerging market, it tells us where we are at. We haven't had a real recession since the financial crisis. And if I'm right here in terms of the move here, then this is going to be first a deflationary bust, but then I think there's something coming after that. The deflationary bust is not what gold is going to like. The structures here, this is called a negative diversion. So you've got lower highs on the momentum here, and you always got 3 highs on that. So when we get there, I think then we're going down, and that the level should be lower than what we got over here. So that's going to be rather devastating.
If the Dixie goes to 91, 93, you still don't think gold's going to take out 2100?
No, because there is not that correlation between them. I mean, it's not that simple. It's not just about that, because if we see 91, 93, what is going to take off a lot is crypto, and it's going to be a risk on
Yeah, I noticed you're dabbling in a new arena. I saw, I keep up with you, buddy. In fact, I have cameras in your office and a microphone. But I see you talking about altcoins now, Henrik.
Yeah, sure. But
go ahead.
Well, I do learn also. I mean, we learn, and we have to say that 99% of altcoins are going to get eradicated at some point. But for now, it's a gauge of liquidity. It's a gauge of when liquidity starts to come into the market and speculation comes into the market. Risk on sentiment comes into the market. So I think it's about gauging that and looking for those for that. And then of course there are also trading opportunities there. I'm long Jasmine and some other coins now. Do I trust them or believe in them in the long future? I have no idea. But what I see right now, you're
trading patterns. You just cover up the title. How's liquidity in that stuff? Bid offers and things like that. 5%.
Well, yeah, I don't know. Actually, I don't know, Dale. But it seems like the liquidity on the larger scale is coming back now. That's what we see, and I think what we can see in terms of the macro numbers here, that Fed may want us pause very soon, or and I think that will help the market. And what we also see, and then what is even more important, I think, is that we're going to see a major top in the rates. We saw the top actually in October of 22, and I think what we have had here now is the first decline. We've seen then the bounce, and now we're up here again, and I think we're going to see this move down here. And when that starts to move, then it's a bigger move to the downside. And I just wanted, if I can just zoom out here a bit.
Under 3, yeah.
Way under, because if what you look at here, I mean, again, I love to use momentum. Momentum is very, very important in trading markets for me. And if you look here, you say you got a negative divergence here right into this top, and you saw the decline.
Yeah.
You saw a negative one here, you saw the decline. And what we got here now, we have a negative divergence right again, and we actually also see momentum is down further. So I think it's just about us. It's about, it'll take it'll take some time before we get but we are actually getting to one of the bigger moves here now, as I see it. So I think the move is in now, and that's why I also think that the altcoin season is starting, because what we want to see there for altcoins and liquidity, they want to see rates coming down, and that's what we're going to see now.
So a recovery move in bonds and notes coming. Because you're looking at a 10-year yield. The bonds, TLT looks like an ascending triangle to me, that if we take out 109, it's going to look pretty good. So it's not, bonds aren't going to do well because of risk off. They're going to be supporting the market melt up.
They are going to be supporting for a certain amount of time, and that's actually also what you saw in 2019 when you saw that we had the move in. I don't know if I can go back here now, but you saw that. In 2019 also, where you saw that bonds and equities were moving up together, and
they moved down together in 21. That was the worst bear market in bond history. They were both bad in 21.
And I think you'll get more of that, because that's the moment when inflation is actually the driver of the decline. But when deflation is, because the economy is contracting, then bonds and TLT will do better, right? So I think there will be a time here during this crash here where we're going to see coming, let's say October or December of this year, where TLT and bonds will do fantastically. And I think it'll go up a lot. But I think, not holding on for too long, because I think we're going to see somewhat more of what we just saw a prelude of in 22, where we had the bear market both in of the declines both in equities and bonds.
So long the world now, short the world then.
Yes, something like that. And then there'll be the time for, and gold will have its time, and that will be when the Fed, whatever is going to go back in, when they want to, when they stare at deflation in the eyes, then that will be the time for gold, and there will be a tremendous opportunity at that point.
I heard you raised your target for gold from 800 to 12.
Yeah, that's right. I mean, again, I'm not, Richardson Stubborn, and that's not really my play here is more about the miners,
market.
Which need to beat some,
okay.
Gold miners and silver miners that I want to get into. There's a list that I got that I want to, invest into, but not yet.
Yeah, I caught a wave and got out early on this last wave that we had.
Oh, really?
Yeah,
okay.
I think we bottomed at 27 GDX, went to 33. Yeah. You mind showing your roadmap in the miners? It's just for me. I'm not saying a friend is asking.
No,
I want to know.
You want to know? Let me see if I can get it. Then I think I need to open it up. I'll see. GDX.
Oh yeah.
Let's see. Yeah, sure. So I think we're going down from here. I mean, there are some. Let me just get it. Just need to load here. Come on. There it is. Nah, but it needs to load. There we go.
Oh, okay.
So yeah. So in the bigger picture, this is also supporting the fact that we haven't seen a new bull market in gold. Because if you were in a new bull market, we would also see miners lead, and we don't. We see miners actually lead to the downside.
They did a little better on this last wave. But
sure.
Yeah.
But it is. But to me, it's about the bigger picture here. And I said that, and that's why I think everything that's been happening after the financial crisis has just been some sideways movement up, and some tech stock has been going up a lot. But in a bigger perspective, this is a major winter and quadrature term that is now going into its final and worst phase, which will be a major deflationary bust. And think about
and 6,000 S&P is going to just, you know, it's kind of like the late 20s. Happy days are here again.
exactly.
You know, popping the champagne cork. The
Yes.
economy's already faltering.
Right.
You know, there are already cracks. But
it is, but you can see that.
people
You can
think
see that
it's great with the S&P at 6,000, right?
Yeah,
Everything's
but
fine.
You'll get people, you know, flocking in at that point. That's the problem here. That is actually the problem. You'll also see that in crypto. I think you'll get a lot of people getting caught on the wrong side of this trade, both with equities and with crypto, and that's the problem, right? But I think, you know, for the miners here, I think we are in a big, you know, this kind of descending wedge or triangle here. I think we got an A, we got a B, and then we got this 5-way move. And I think down below $10, then GDX is worth buying, and that's the point, and that's the case.
Wow.
So, but if we look at it, and I just want to show this in terms of why we could also look at the similarities to what we had in 2007. So this is NAHB, the housing market, right? That's the blue line here. And then we got the unemployment rate, and we got that as a red line here, but it's inverted. So the top here is the bottom in unemployment rate. And what we see is that when we get, you know, into the cycle, we see the top in the housing market, and it starts to decline, and then later on you get the bottom in unemployment, and it starts to rise. The same here back into the financial crisis, and you saw the strong decline in the housing market, and then the strong rise in unemployment rate came. And look at what we got now. We got the clock has started, and it started there in October of 20. And we're then seeing this decline here. And we're right now in this bounce here. I mean, that's the similar kind of structure we got. So all of, you know, almost. And we're in the bounce. And I say we have another low coming, because that's when the recession comes, which the yield spread tells us about. So when people start to get unemployed, and that's when this starts to go this way, go up, then people will again start to feel difficulties in servicing their mortgages and the like. So we're going to see bottom in unemployment rate, and probably maybe it has been there already, but we're going to see it come down rather strongly, or the unemployment rate going up rather strongly, right? And I think we have just a replay of what we had there, and that's what we are in for. And this time around, debt around the world is so much bigger. And if you have the S&P at
leverage,
500, leverage is so much higher. You got a crypto market that will explode. I mean, and I think it's going to go to around 5 trillion in value before it actually implodes. I mean, implode, not explode.
Does that mean 100,000 Bitcoin?
That means around 100,000, 190,000 to 120,000 on Bitcoin. Yeah.
Okay. Great interview.
Yeah.
Great interview, buddy.
Yeah, it's easy to keep me up to these numbers, right?
Yeah. Well, I'll tell you what. I always root for you, Henrik. The good, the bad, the ugly. I think your heart is in it. You're doing the best you can, and I've seen you make many prescient calls. So when I have a friend, I stick by them and root for them. So I'm rooting for some people to subscribe to your stuff. Why don't you show them how they could do it?
That's fantastic. Thanks, Dave.
Go ahead. Why don't you show where people could, maybe you could put your website up?
Yeah, sure. So we got the, let me see if I can get that on here now. Okay, we got the secret report. So that's where we have the weekly show. So where I get on, and on a weekly basis, I simply tell about, where I see the economy heading, and trying to navigate the different news coming out of the economy. And this is the one. So this is the HT updates weekly show. I'm on online, and we have questions coming up, and I try to give a perspective of where are all the most important asset classes going, and when will we see a blow off top, and why is it still, even when people are starting to be afraid. And for instance, when there was this banking crisis, and we kind of had the indicators that said, well, we are not going to go down from here, and it actually sure turned out to be quite right. So and this is the same again now. We've heard so much over the last couple of days here, and it seems to be the wall of worry that is now climbing, and we see that liquidity is coming in, and all the things that is just the normal part of a bull market, which is just so disliked, which I can understand. But it's just not the correct positioning at this point, and I think
it'll be the most hated blow off in market history.
Yes, exactly.
And if you're right, many bears will get buried trying to short it all the way up.
Exactly. And some will get bullish just at the point when we reach the top. And but for this, at this point here, I'm not, with things that are going on, I don't see why we should be in the momentum in the market. If I show my S&P chart here, actually this one here, this is the 3 month, I guess it is, but come on, it needs to load here. So now it's and what we see is that
monthly.
Month. This is a monthly, And what we got, of course, we got the negative divergence on this one, but as soon as we move in on a weekly basis, you can see that then we have on a daily basis, we actually have that momentum is moving higher, and that's what we want to see. We see here that you have that first you had when it moves down, that you have a positive divergence on momentum, and now you have momentum moving even higher here. Yes, and we will have around these tops here, we do have pullbacks. But that's all it is for now, and that's normal. You also have pullbacks in this strong rally here. So I say that this was the first move up from the October low. First move, A, B, C, and there's a second wave.
And we're in 3.
We are and soon we are in 3 of 3, and that's the strongest one. So I think into summer we are at the all-time high. It's going to go really quick from here. So that's what I'm seeing.
Okay, so we'll be celebrating around the barbecue this summer, huh?
If I'm invited, I will come by.
Henrik, you're always invited, and really great to talk to you today. Thank you for sharing your views with our community, and keep in touch with me.
Yes.
And really eye-opening, some of these charts you shared today. Much appreciated.
Thank you, Dale. Thanks for having me on.
Follow Henrik on Twitter at Henrik Zeeberg, and keep an open mind. It'll keep your account open. See you later, Henrik.